Enable.
In the dynamic and ever-changing financial world, the dominance of the private mutual fund industry continues to grow each year. But the last 25 years have been nothing short of challenging. India had just announced its intent to shift to economic liberalization, and the private mutual fund industry was born. It would still take another 2 years before the first of these funds would be launched. The early 90s was not an easy time. As India was opening up its doors to global investors, a mega crisis for the stock market was unfolding. The infamous Harshad Mehta scam. But the entry of the private mutual funds was already in the works. The government had allowed the private sector into an industry that was until then controlled by the Unit Trust of India. Kothari Pioneer Mutual Fund was the first off the block in July 1993.
That time it was just an era of openness, open to innovation, open to possibilities, that the feeling of, okay, we can do anything and everything is possible. So that was the environment of 1993. Not just amongst the players, like I said, the regulators, the people who were putting in the capital. The investors were also curious as to what this mutual funds are all about, the distributors, the intermediaries. I think there was just a phenomenal excitement in the air, even at that time.
The launch was greatly helped by the experience that Pioneer had as a leading symbol of the mutual fund industry. Early 1994 then saw the much-awaited entry of Morgan Stanley through their 15-year closed-ended growth fund. It was the time of the IPO craze, and investors lapped up the schemes assuming they were IPOs.
93, the markets were booming worldwide, so in a way, by the time the fund came out, things were very heady, which was exciting, and there was a lot of interest in India and particularly our fund. So that was the good news. The bad news was this was early stage in India's financial development and in the mutual fund business. So the way we had some distributors helping sell the fund, and there was some confusion about what was projected or what was understood. The investing public was nowhere near as sophisticated as it is today. So yes, you're right. I mean, there was some confusion whether it was a limited offering. Some people thought that Morgan Stanley itself was IPOing rather than a mutual fund. And so that was both disturbing and not very helpful, but was very hard to manage and control. So that confusion was not good for us, not good for the investor, not good for the growth of a fledgling mutual fund industry.
The response was phenomenal. A 300 crore rupee fund, which was meant to give allotment on a first-come, first-served basis, ended up retaining the full 900 crores that was subscribed. The first NAV recorded showed a 10% drop post the deduction of the initial issue expenses, and this irked many investors, creating further panic.
These were very inefficient markets, very early days, lots of rumor, not enough facts and education and news going around. There was tremendous speculation of where the fund would trade relative to its NAV, and that premium would be affected by how much money we took. So there was some confusion on that, and some speculators got hurt in trying to game and time that premium, and that created some sort of backdraft and negative publicity for us. I think a little bit of it was probably deserved because, again, as I said, it was early pioneering days, and it was hard to control the media, the distributors, what was said to whom, but largely, I think, undeserved. But that's life in the fast lane. when you enter into a new jungle and hack your way through, all kinds of things happen.
Making matters worse for the newly launched funds was a 5-year bear phase that followed the market peak in September 1994. The early 90s was a period of rapid changes in mutual fund regulations in a bid to make them more investor-friendly. SEBI introduced a more exhaustive list of regulations in 1996. In 1999, the market started looking up again, and the following years saw frenzied M&A activity. Zurich Mutual Fund took over the 20th Century Assets Management Company. The same year, Zurich also acquired ITC Threadneedle, only to sell out to HDFC AMC about 4 years later. Sun F&C Mutual Fund acquired Jardine Fleming Mutual Fund, sponsored by JP Morgan India in 2002. The very next year, Principal Mutual Fund took over Sun F&C. Kothari Pioneer became Pioneer ITI after the Kotharis sold their stake in ITI, only to be acquired by Franklin Templeton a year later. In 2004, Birla Sun Life acquired Alliance Capital. In 2009, L&T Mutual Fund came into existence on buying out DBS Cholamandalam. A few years later, L&T Mutual Fund also bought out Fidelity's India Mutual Fund business. In 2011, Goldman Sachs Asset Management acquired Benchmark AMC. Morgan Stanley's schemes were also brought out by HDFC Mutual Fund in 2013. And this is just to name a few. By the year 2000, the private mutual fund industry was already managing assets worth 1 lakh crore rupees. And a lot of the credit goes to the well-planned industry itself.
I think what the mutual fund industry would have done very early in its existence is that they almost our operations are centralized, right? There we have got an RTA who has got common processes across the industry. When any new change happens, we all sit together in MFI and decide how will the new change be implemented. It is informed to the... So, in the early stages of the evaluation of mutual funds, the RTA did a brilliant thing by getting all the processes standardized, right? And because of that, there's a lot of efficiency, right? Because practically operations department of various mutual funds are having they don't have to create separate softwares. There is one common software. So a lot of things have been standardized because of this, and that has brought in a lot of efficiency and cost control within mutual fund industry.
The 1998 to 2003 period was a period of growth. The industry grew at a CAGR of over 20% during this time.
If you look at the growth of this industry, I treat that in two phases. The first phase, in my view, is the 20-year phase, which is 1993 to 2003. And in that phase, you saw a lot of regulation in place, and a lot of regulators actually played a key role in making the schemes a little more prudent and ensuring that the investors' interests are taken care of. So the corpus of mutual fund industry went up from 48,000 crore of rupees to around 7 lakh crore of rupees by 2013.
These regulations, which were put in place following the 2000 tech bubble.
There was a bubble of telecom, media and technology stocks. We were multiplying money like crazy. And then we launched a sectoral fund on technology, media and telecom to raise money right at the peak of the market. Once the bubble busted, our funds came down by 40, 50, 60, 80%. And there was a huge backlash from investors. We learned our lessons hard way, that we have to be different from retail investors.
Most industry watchers give credit to the market regulator for bringing in fresh regulation as an almost immediate reaction to any fresh crisis. Post the tech bubble, SEBI immediately barred mutual funds from investing over 20% in any single stock. The fallout was also felt through the Ketan Parekh scam. By 2003, the mutual fund industry had sought some redemption and really came on its own, doubling its assets under management to 2 lakh crore in 2005, increasing it further to 3 lakh crores in 2006, and then doubling that to over 6 lakh crores by May 2008. But the calm was soon to be shattered.
The sudden and shocking collapse of Lehman Brothers.
The Lehman crisis unfolded less than a week after a new Reserve Bank governor took charge.
Bond yields had gone up, call money rate had gone up, exchange rate had nosedived, capital had fled, and there was fear, uncertainty in the banking system. So our effort in the Reserve Bank was to ensure that our financial markets function properly, unlike the Western markets, which are close to being close to seizure, and to also ensure that credit continued to flow.
The entire world was reeling from the aftershock, and naturally, the private mutual fund industry in India could not remain immune.
Clearly, we needed a liquidity line. Now, under RBI regulations, they were not allowed to extend credit or line to anyone other than bank. We clearly had to work with SEBI and with RBI to appraise them of the situation. And fortunately, both the regulators were really, open, and they were willing to help. And they created a mechanism to provide liquidity to the market, mainly to the banks, but also to the mutual funds via the banks. And that liquidity actually came as a big, big lifeline. Without that, I don't think so we would have survived. And it was a lesson whereby clearly we had to manage our funds within the constraints. And thereafter, the regulations changed to ensure that liquid funds maturity was restricted at 90 days.
The regulator, the Reserve Bank of India, and the industry was quick to bounce back. Armed with fresh regulations and an undeterred resolve, by August 2009, the industry had further increased its asset base to 7 lakh crore rupees. 2009 was also a year of big change. SEBI chief C.B. Bhave abolished the entry load of mutual funds.
I think that decision by Mr. Bhave to introduce the abolition of entry load was a masterstroke, although at that point in time it became controversial because this was the way of ensuring that more number of small investors get into the mutual fund route. What was happening was that entry as well as exit was being levied a charge. Now, what Mr. Bhave did in 2009 was, and much against the conventional wisdom at that point in time, he abolished the entry load, and the mutual fund industry was very upset, very unhappy. But I think in the final analysis, it saw increased interest of the small investor into the scheme because the entry barriers, so to say, were removed.
The next few years were spent on growth. January 2010 saw the online revolution in the mutual funds industry with the introduction of demat accounts. This followed closely with compulsory KYC norms within the span of a year. SEBI took on many brave firsts, addressing the lack of penetration, inadequate distribution, need for greater alignment of the interest of various stakeholders, regulation of distributors, and issues concerning investor protection in their meet aimed at re-energizing the mutual fund industry.
The background for re-energizing Indian mutual fund industry concept came after almost 2.5 years of removal of entry load. That was on 1st of August 2009. SEBI put a stop on entry load collection from the customers. So for a period from 2009 to 10, 11, 12, the entire sentiment towards capital market was low in general, and Indian mutual fund industry also had its own tough time during the period to get inflows both in fixed income and equity. That the re-energized Indian mutual fund industries came with the scores of suggestions. And one first suggestion that came, which many times I quote this, that even the marketing textbook do not carry the definition between T15 and B15. We normally used to saying Tier 1 cities, Tier 2, Tier 3 and Tier 4, whereas Securities Exchange Board of India came with the new terms called T15, which is top 15 cities, and B15 cities, which is below top 15 cities. And they came with some kind of structure, which indirectly means that you can incentivize the people more as long as they come from B15 cities.
SEBI also mandated mutual funds to differentiate between direct and distributed plans, with the mandate coming into effect from January 2013, coinciding with the BJP win in 2014. Industry's assets under management crossed the 10 trillion mark for the first time in May.
From 2008 till 2014, nothing happened in the equity markets, with the process that nothing happened in the mutual fund industry. There were negative flows. In 2014, because of the new government coming in, there was buoyancy in the market. Market started doing well. When the market started doing well, the mutual fund NAVs started doing well and they started showing positive returns.
Mutual funds, sahi hai.
Then came the Mutual Fund Sahi Hai campaign. And suddenly, all kinds of mutual funds made their way into our living room.
At the end of the day, the mutual fund industry the last so many number of years have been driven largely through risk management, volatility of the market, and the returns are subject to market risk and so on and so forth. So most of the people used to remember mutual fund as subject to market risk. While it is true, there is absolutely no untruth in that. But at the same time, we need to also project this actually helps you save your money for your long-term goal purpose. So therefore, we need to reverse the game. And first we start with a positive approach that yes, mutual fund is a great vehicle for you to put your money for your long-term savings and long-term goals that you need to meet. At the same time, you need to also maintain the fact that the mutual fund is subject to market risk. Therefore, the both have to go hand in hand, and that's why we came with this idea of mutual fund sahi hai, yes, it's sahi hai, but it's subject to market risk, is also meant for long-term.
8 November 2016 changed the game again. When Prime Minister Modi announced demonetization.
New notes of 500 rupees and 2000 rupees with completely new design will be introduced.
Today, the mutual fund industry stands tall as a 24 lakh crore rupee giant, nearly 1/5 of the banking system. Despite the success, direct plans still remain a mystery to most investors, and many allege that they are not promoted as well as the regulator plans, owing to the lack of commission, something even the current SEBI chief took note of in this year's AMFI Summit.
While direct plans are available in our market since 2012, the advertisement and publicity for such plans is still being undertaken as a very low-key affair. More investments through direct plans has many advantages such as lower transaction costs, more transparency, and lower instances of mis-selling. There is a strong case for AMFI and the fund houses to educate investors about direct plans and to suitably advertise and promote them.
Following this announcement, SEBI also went out to bat in favor of the retail investors and capped the expense ratio of mutual funds.
The market regulator has capped the total expense ratio of active funds at 2%, though the reform is aimed at attracting more investors to mutual funds.
Close on the heels of this move, the debt fund industry was dealt a near body blow by the liquidity crisis at IL&FS.
Big 90,000 crore IL&FS, defaulting on once a commercial paper and then an intercorporate deposit to SIDBI.
The road ahead isn't smooth. There are multiple challenges that threaten the future of this growing behemoth.
Focus, ideate, innovate, enable.